This is a stablecoin. Under US law since 2025, it is not allowed to pay you interest, which is why every major bank quietly started building something else, the tokenized deposit. JPMorgan already put one on a public blockchain, and Citi moves close to $1 billion a day on theirs. In the next 7 minutes, what a tokenized deposit actually is, who is live right now, how it stacks up against stablecoins and CBDCs, and the 2 laws that quietly decided the winner. Start with what your money already is. The balance in your bank account is not cash sitting in a vault. It is a liability, the bank's promise to pay you. A tokenized deposit takes that exact promise and records it on a blockchain. It stays on the bank's balance sheet. It stays a deposit in the eyes of the regulator. Where the underlying account is insured, it stays insured. And because it is still legally a deposit, it can do the one thing a stablecoin cannot: pay you interest. A stablecoin is a different animal. It is issued by a company, not necessarily a bank. It is backed by a pool of reserves, and your claim is on those reserves. It is money that behaves like a bearer instrument. Whoever holds the token holds the value. That design is exactly what makes it powerful for open, permissionless payments, and exactly what regulators will not ensure. The Bank for International Settlements drew the line in 2025. Sound money, it argued, has to pass 3 tests: singleness, elasticity, integrity. Its verdict? Stablecoins fall short on all 3. Its blueprint for the next financial system runs instead on a trilogy: tokenized central bank reserves, tokenized commercial bank money, and tokenized government bonds. The governor of the Bank of England put it plainer. He would, quote, "Much rather banks issue tokenized deposits than their own stablecoins. This is not a white paper category. Here's the scoreboard as of this month. November 12, 2025. JPMorgan makes JPM coin available to institutional clients on Base, a public blockchain. A dollar deposit at JPMorgan Chase Bank, living on a public chain, moving wallet to wallet, around the clock. Coinbase, MasterCard, and B2C2 ran the proof of concept. Behind it sits Kinexys, the bank's private rail, which by April 2026 had processed over $3 trillion since inception and was averaging more than $5 billion a day. Citi says its token services runs live in 5 markets, with hundreds of clients moving close to $1 billion every day. And 4 days ago, Siam Commercial Bank became the first financial institution client to go live on it, moving dollars for a Thai brokerage over a U.S. holiday weekend. Germany built a consortium: 5 banks, 5 corporates, 1 token, the commercial bank money token. In May, the first live transfers ran between Siemens and Evonik. Sensors metering chemical consumption on a factory floor triggered deposit token payments across 2 different banks. Machines paying machines, in regulated bank money. Japan has been in production since 2024. DCJPY, an actual tokenized deposit network, where 1 yen on deposit mints 1 token. Japan Post Bank plans to bring it to its depositors this fiscal year. And for honesty's sake, the contrarian. Societe Generale chose the other lane, issuing regulated stablecoins in euros and dollars instead. One major bank disagrees with the rest. That is what makes this a real race. So which rails win? It depends on which seat you are in. Issuer. A stablecoin comes from a licensed issuer holding reserves. A tokenized deposit comes from your bank. A CBDC comes from the central bank itself. Your claim: reserves, bank, or state, in that order. Insurance. Only the deposit keeps deposit insurance, where the underlying account has it. Yield. Stablecoins are banned from paying it, in the US by statute, in Europe by MiCA. Deposit tokens can. CBDCs by design in most proposals do not. Access. And here the stablecoin wins. Anyone with a wallet can hold one. A deposit token needs you to be a client of the issuing bank. JPMD is institutional and permissioned. Open access is the stablecoin's moat, and it is a real one. Scale today: $310 billion of stablecoins outstanding. Against that, US bank deposits alone are $19.4 trillion. The deposit token bet is that even a sliver of that base, moving on-chain, dwarfs the stablecoin market. Citi projects bank tokens could carry $100 to $140 trillion in annual transaction volume by 2030. Note the words: annual flow through the rails, not balances sitting still. Different measure, deliberately so. None of this is an accident. It is written into 2 laws on 2 continents. The Genius Act, signed July 2025. Its definition of a payment stablecoin expressly excludes, quote, a deposit recorded using distributed ledger technology. And Section 4 prohibits stablecoin issuers from paying holders any form of interest or yield. Read those together. Stablecoins got a federal rulebook and lost the right to pay you. Deposit tokens stayed deposits, outside the act, yield intact. Europe mirrors it. MiCA excludes deposits from its scope entirely, while e-money tokens sit inside it, where Article 50 prohibits interest. Same split, same winner. And when Germany's regulator looked at the consortium token, it classified it as a bank deposit, not e-money. At the Federal Reserve, Governor Waller frames the future as two competing models: the stablecoin sandwich, converting dollars to tokens and back, versus banks putting deposits themselves on chain. The plumbing war, out in the open. Here is the operator lesson, and it is the one this channel keeps arriving at from different directions. Every tokenized asset needs a cash leg. When Hong Kong sold bonds on a blockchain, the hard part was not the bond token, it was settling the money against it. The same question lands on every issuance. What settles the trade? Central bank money, through rails like the Bundesbank's Trigger solution and the ECB's coming Pontus pilot. Or commercial bank money, a tokenized deposit. So the rule: your token is only half the trade. Choose the money leg as deliberately as you choose the token standard. And regulation just made bank deposit tokens the only cash leg that can pay yield while it waits. That is also where this connects to the tools. Platforms like Bitbond tokenize the asset side of the trade, the bonds, the funds, over $1 billion of them through thousands of smart contracts. Deposit tokens are the money side those assets will increasingly settle against. Two legs, one trade. The banks are not asking whether money goes on chain anymore. They are arguing about whose money gets there first. New episode every Tuesday. The Hong Kong bond story is the natural next watch. Subscribe and we will follow the money.